hello, everyone. Thank you so much for coming today. I'm pleased and honored to be here. So thank you all for your time and attention. So I'm going to be talking about angel investing in numbers. So this is sort of my personal take on my 11-year career as an angel investor. I started investing in 2011, and I've captured some of the ideas and what I've learned here. And so this is just my perspective, of course. This is not the correct answer to anything. It's just my perspective based on my limited life experience. So I'd like to just start off by telling you what the outline for the talk is. First, we'll introduce each other a little bit. Next, I will talk about what happened on Wall Street. So in the 1990s, I ran a hedge fund, an investment fund. And I think that a lot of what is going to happen in the private markets and angel investing is going to mirror what happened on Wall Street between the 1950s and today. So I view what happened on Wall Street in the public markets as being a few decades ahead of what will happen in angel investing. And so I think that understanding a little bit about what happened on Wall Street will help us understand what is going to happen in angel investing. I'll talk a little bit about where we are now in the investment climate and startups and angel investing. And then finally, I'll tell you a little bit about what some of my insights are, things that have a little bit of data to support them, and then some guesses, things that I think are true, but don't quite have a lot of data. And then we'll have some time at the end for questions. So let's start off with just the following introduction. So just into the chat, type in your name and your location, and I will do this myself. Your angel investing experience. So I'm going to say investing since 2011, invested directly in 30 startups. And then finally, I'll say what my favorite breakfast food is. And it's like a tortilla with jam. So you can go ahead and just hit return, and we'll just take 30 seconds, and I invite everyone to do that. That way we'll learn a little bit about each other. We can see all of the introductions in the chat. Big smile from Ella. Hey, Polly likes eggs and cheese. Oh, Richard, Lowell, Mass. We're neighbors. It's great that we're doing this. Maybe we should get together. I live in Boston, Cambridge to be more specific. Madrid. My father was born in Madrid. Nice wine and cheese. Excellent, Madrid. Actually, my father was just in Madrid a couple of weeks ago. Okay, so let's see. Okay, so Fernando likes avocado toast with large coffee. Pedro likes baby pig. Wow, interesting. I don't know how to eat that. Khalid, France, fruit salad. Cynthia is like Madonna. All we need to know is her name. She's so famous. Needs no introduction. Let's see. Adrian, from Romania, like boiled vegetables with avocado. George, oh, I know George. Chile, very successful. Investing in angels is 2004. Another avocado toast and tea. Excellent. All right. Well, great. Bread avocado. Okay, maybe I need to focus a little bit more on my avocado because I don't know that much. Istanbul, I've been to Istanbul. I've been to Çeşme, and I've been to Izmir a few years ago. Very, very exciting. Anything breakfast related. Istanbul as well. Olive cheese, egg, and tea. Fantastic. All right. Well, great to hear from everyone. So I'll just say a few words about myself. The reason I'm introducing it this way is simply because you have some understanding of where I come from and what my experience is, and so therefore what my perspective is. So in the 1990s, I started a company based on natural language aspect of artificial intelligence. It grew to about 50 million in revenue, 200 employees, and it was acquired by Oracle. And then I was a VP of corporate strategy at a company called Softricity, which did some early software as a service stuff, and it had an exit to Microsoft. And then I've invested in maybe 30 startups. The numbers have gone up a bit since this slide was created. And then through funds, I've invested in many more, 50 plus more, 100 plus more. I've had 4 unicorns. So a unicorn is a company that's worth over $1 billion. These were all invested before round A. Astranis, Boom, Rappi, and Relativity Space. For those of you who read Hacker News, Boom is actually the top story right now because they just sold a bunch of their supersonic jets to American Airlines. And then I have a PhD in computer science. And so a lot of my interest is in quantifying what is going on so that I can make better decisions. Okay, here are some caveats, which I'm going to take quite a bit of time to explain because I think it's very important because all of us have a very different perspective. And I want to just be very clear that this is my perspective. It depends on my context. And since my context is different, everyone's context is different, what makes sense for me and what I've learned, it might be different from what you've learned, right? So there's no right or wrong answers. I'm simply sharing with you what I've learned. So first is that I'm based in the United States. And while I have investments in other parts of the world, like I have an investment in Argentina, for example, most of my investments are in the United States, and I've never invested as an investor in other countries. Like I've never lived in another country and invested from there. It's always been from the United States. And the United States can be very different from other parts of the world. The capital markets are very well developed here in the United States. And so I'll just give, a couple of examples sort of at the beginning and at the end. So at the beginning in the United States, starting a business is very, very, very straightforward. The mechanics are very, very, very straightforward. Calling up a lawyer, calling up an accountant, filing the paperwork, opening up an account at the bank are all very straightforward, simple things that anyone can do and has been developed over decades and decades. So one funny example of this is that when I was in college, I worked in Germany, I worked in Munich, and I worked for Siemens. And they gave me my first check, which was a paper check. And I went to the bank and I wanted to cash the check. I wanted the money for the check. And they said, no, we will not give you the money, even though it had Siemens, I had, my card and all of these things saying I was an employee at Siemens, but I couldn't cash my check in Germany from Siemens, right? And so I had to come with a Siemens employee to the bank, and the person had to say, yes, they work at Siemens and I work with them so that I could get check cashed, right? So some of those things like that are just much, much simpler. And so that's one difference that I've found, right? So for example, in the investment I have with Argentina, that company is based in Argentina and all of the people are in Argentina, but because of some sort of legal laws in Argentina, the company is actually incorporated in Uruguay, right? Which would be, completely unheard of in the United States, right? And the entrepreneur explained to me that it's because of particular rules in Argentina that make it difficult for a startup to be successful, that they actually incorporated in Uruguay. And so now that entrepreneur needs to manage, in some sense, a multinational corporation when there are only just a few people. And then I want to talk about the other end of the equation. So I talked a little bit about starting a business. Acquisitions in the United States are also very well developed, right? So small acquisitions, which are say below 50 million, can happen very, very quickly in the United States. They do not require often executive approval. They don't require an executive contact. So as a simple example of that, I invested in a company in Silicon Valley, California, and it was exiting for about 15 million. So a very, very, very tiny exit. And the entire due diligence process was that the two founders showed up at the acquiring company for a day, and they had conversations with director level people, sort of mid-level people there for a day. And at the end of that day, they were told you're acquired or you're not acquired. right? So the entire due diligence process was a single day. Now, there would have been legal stuff afterwards, but the agreement would already have been in place and the company would already have declared their interest, right? Whereas due diligence tends to be an extremely difficult thing very often. The second thing I'll say is that the goal here is to maximize returns, right? So that's sort of my interest. And there are many, many other reasons to be a business angel, right? It might be interesting or fascinating to mentor. It might be part of someone's goal to give back to the previous generation of folks. It may be that someone has a passion for, say, climate change, and they want to contribute to improving things. Here, I'm simply focused on maximizing returns. And there's a sort of a simple reason for this, which is that when we're talking about institutional investors have extraordinary amounts of capital, infinite amounts of capital, and if they lose a bunch of money, they can get more capital. Whereas for individual investors, someone like me, if I don't earn a positive return early in my career as an angel investor, I'm not going to continue. I'm just going to stop, right? So that was my experience. So like when I started, I put aside $500,000 and I said, I'm going to make $25,000 investments. And if I had lost money on those $500,000 and it had gotten smaller instead of bigger, I would not be an angel investor today, right? And so we know that the returns to angel investing are positive. They're much better than in the stock market, but that's an average, right? It's an average. And so the question is, how do we actually get that average or better, right? There's a wide range, and many, many angel investors actually lose, particularly at the start. And if someone makes investments and then they stop, then that's it, right? And so maximizing returns is particularly important for me when I was starting out. The third thing is I'm focused exclusively on early stage investments. So this is before round A. Typically, I like to be the first check into a startup. About 1/3 of the time, I'm the first check in. And I'm always investing at, say, like $15 million or less in terms of valuation. Valuations have gone way up. It used to be like 5 million or less, but they've gone way up in my career. And so now it's like 15 million or less. But it's before any significant professional money, VC money is in the company. Sometimes I'm co-investing with a small VC, but it's never like the very big VCs, the very big checks being written. And finally, I'm very, very biased by my experience in what I've invested in. So almost everything that I've been investing in, it has been tech or fintech, deep tech, things like that. I don't invest by and large in other areas. Simply, I don't understand them. And even within that broad, very tight area, most of it has been in software. I do have some investments in other things like Boom, which builds these supersonic jets, so very, very fast planes that are going to be able to take people very quickly from, say, New York to London in 3 hours. But vast majority of my investments, maybe 60–70%, are in software. And then the final thing is I have this experience of managing a hedge fund. And I learned a lot about the investment space that's very, very quantitative, sort of a quantitative technical approach, right? As opposed to saying, well, I'm going to learn about the founder and I'm going to learn about their story and I'm going to learn about their motivation. My primary interest is in understanding the numbers. Okay, so with those caveats, we'll get started. Okay, so I'm going to first talk about here the history, a little bit of Wall Street and what has happened to small investors, to retail investors. So this is the public markets, stocks that can be bought on a stock exchange, right? So in the 1950s, there was this famous book called Where Are the Customers' Yachts? And it's this story about this person going out and seeing all these yachts and saying, oh, those are the yachts of the brokers, right? The people who are selling this stock to the retail investors. And the person asks, well, where are the customers' yachts, right? The people who are buying the stock from the brokers. And of course, there weren't any, right? Because it's the brokers, the middlemen, who are making the money. And then today, that world has changed completely, right? So in the 1950s, it was a very sort of story-based or narrative-based type of approach to investing. Like, let me tell you a story about why this company is great, why the management is great, why the product is great, why distribution is great. And maybe there were a small number of numbers, like the PE ratio or discount value, things like that. But it was a lot of text, so to speak, and very few numbers. Today, we're the opposite. We're in a world where, PhDs in physics, PhD in mathematics, like Professor Simon here, completely dominate the market. The vast number of stock trades are done by these algorithms. But there's one thing that both eras have in common, which is that small investors really don't stand a chance, right? The idea that a small investor can sort of read the newspaper and watch TV and outperform the stock market, that is not something that happens very often. And there's quite a bit of data to support this. But before we look at the data, I'll just show that what the market does do is it provides more and more ways for small investors or retail investors to lose their money. So, Robinhood is a great example of this, where, people got very excited on this, got very excited about crypto. And when everything was going up, they were all making money. And then the amount of money that was lost and what happened to the stock price of that, was just extraordinary, right? So there's a big difference between getting rich by being good and getting rich by getting lucky. And what constantly is happening to small investors is that they are being sold products that require luck to be successful. And so here we have Interactive Brokers that provides access to 200 countries and territories. That's a lot of countries and a lot of territories to trade stocks, options, futures, currencies, bonds, funds, and crypto. And you can do this all from a cell phone, right? And the individual investor can do this all from their cell phone. And I view that just as a large number of ways to make mistakes, right? That's not opportunity. That's just the middleman saying, look, I'm going to give you all of these options and you can give me money every time you trade one of these options. Here, put options, for example, are some of the most sophisticated things available to individual investors. And here's an article aimed at the small investor saying that you can benefit in any market, right? So it's very, very difficult as a retail investor to even know what is true or what is not true. So what the data shows is that the best thing for a small investor to do is just to buy a broad basket of stocks and do nothing. So in this great chart here on the right-hand side is just an index of the S&P 500. These are 500 large stocks. And the black bar is the net return. And then over here on the left-hand side, from 1 to 5, we have the return based on how frequently the small investor is trading. So a 1 is that they're trading very little. So they're basically buying and holding the same position. And 5 on the right side is that they're trading a lot, right? So they're buying, selling, buying, selling, buying, selling. And you can see that the black bar goes down, 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 down. So the more the small investor trades, the more money they lose, the worse they do. So the best thing that you can do is to trade as little as possible as an individual investor. And so we have this is what is happening in the public markets. And so the question is whether or not this is true in the private markets. Is it true as an angel investor that the best thing that we can do is just to buy a diversified portfolio of startups, and that's it? That actually selecting startups, picking startups doesn't actually work. We should just buy a broad-based portfolio of startups. Okay, so I think that that's a key question, and I think over time the answer will be yes. Decades from now, just like the public markets, the private markets, the best thing an individual investor, a business angel will be able to do is just to buy the market. Okay, so before we talk about that, though, I'm going to discuss a little bit about where we are in the market today. And for those of you who are thinking of coming into the market, you may have heard that the stock market is down and valuations are down and things are a lot harder. And the message I want to give you is that 2022 is down, but it is down from all-time unimaginable highs that were set in 2021. So the market compared to just a few years ago is still incredibly strong, and it's much, much larger. So there may be many reasons to invest or not invest in startups to start your angel career today, but the state of the market is not one of them. We're down, but only down from the all-time highs that were set last year. So this term unicorn refers to startups that are worth over $1 billion. The term was invented in 2013 by Eileen Lee, who's a classmate of mine at MIT. And at that time, there were very, very few unicorns. There were like a dozen per year. So last year, there were more than a dozen per month. And in fact, there are some statistics that say that last year there was one unicorn per day. So just in less than 10 years, there's just been this huge, massive increase in startup valuations and in the number of startups being launched. And so when we say that things are down, we're talking about being down from all-time highs that were just unimaginable just 6 or 7 years ago, right? So it's literally the case that people that have been in the market for 2011, 2005, even 2015 can't believe the valuations that startups are getting and the amount of return that's possible today. And I'll say that I can't believe that. You know, when I started in startups in the 1990s, $100 million exit was considered to be absolutely extraordinary. And today, billion-dollar exits are common. So the valuation increases have been extraordinary. And so I'm going to show you just now a bunch of statistics to give you some sense of where we are in the market. So this data is through June 30th. And of course, since June 30th, there's actually been an increase in the market. So early stage, mid stage, and late stage startups. So we've seen a hit in the late stage valuations and in the amount of money going in, but that has not hit early stage and mid stage yet. And one simple reason for this is that an enormous amount of early stage capital was raised already as on the back of 2020, 2021. And that money is just parked on the sidelines waiting. The late stage capital, a big chunk of it is mixed in with public market. So when public markets drop 20, 30%, they're already hit. And so they can invest less. And so then the valuations go down as well. It's also the case that the late stage valuations are very close to public market valuations, right? These are companies that are about to be acquired or about to IPO. And so the usual pattern that we see in sort of a recession, which many people are talking about now, is that first stocks decline, then companies lay off employees, and then real estate declines. And we are starting to see all of that happen, at least in the United States, but we have not seen it show up in early stage and mid stage valuations yet. So early stage and mid stage valuations are still going up. And then if we look at particular sectors, here's blockchain, clearly one of the strongest. And so here you see that in Q2, there was a decline from Q1. But as I mentioned before, we were hitting all-time highs. So if we just go back to Q2 of 2021, just a year ago, year over year, we're still up. You know, we're still up double digits. So we're down, but we're down compared to all-time highs. If we look at energy tech and we look at the number of unicorns being created, in Q2, we went from 17 to 24. So 7 new unicorns were created out of 24 in history, right? So in the previous quarter, we went from 13 to 7, so that's only 4, and then 11 to 13, only 2. So in energy, which of course is one of the markets that's booming now, we are still seeing an increase in the valuations and in the number of unicorns. If we go over to these other areas, wealth tech, funding also down in Q2. You see the bar that says 3.5 billion, but again, it's down compared to the 2021 numbers. It's still massively higher than 2020, massively higher than 2020. And then if we look at fintech, the same story. We had 20 new unicorns in Q2, which is down from 2021, but much, much higher than any quarter in 2020. So that's really the bottom line. And what's happening big picture, and this is my opinion, and this is why I started investing in startups in 2011, is that we're going from the industrial age to the digital age. And there are just single things that are happening, just like self-driving cars that have trillions and trillions of dollars of impact, climate change, tens of trillions of dollars of impact, and all of these things are happening right now. And that thesis is still in play. And these little fluctuations are small relative to this big, huge trend. Like there's no doubt in my mind that in 2040, the world is going to be a radically different place than it is now. And the best way to access that change is to be investing in startups. So that's, I think, what the opportunity is. And so now I'm going to get into what I think are my insights. And this is some of how I invest and some of the things that I have seen as an investor. So the key question that I asked before was, is it better to just index angel investing, right? So just like we do in the public markets, where we buy a large fund with hundreds or thousands of stocks, and that gives the best performance, is that the best thing to do in angel investing? And so the best way I know to index startups, and there's no standard way of doing this, of course, is through this fund called the Angel List Access Fund. So Angel List is one of the huge players in this space. And every year, just about, they put together a fund which invests in a couple of hundred startups in that year. And here on the right-hand side, you can see the IRR, which you can see is, absolutely phenomenal, 25 to 30%. These numbers are through 2020. And so they might have gone down a little bit, but this is, far outperforming the general stock market. And it's a single decision, right? You basically put all of your capital that's in startups in these funds. Every year you start up the new fund and invest in the new fund, and they then go out and they invest in 200 plus early stage startups, and you get these returns. And so I think the very key question for all angel investors is to ask, if I'm interested in returns, which is what we're talking about in this seminar, can I outperform 25% returns per year? And if you don't think that you can outperform 25% returns per year, then the question is, why are you in the space? It might be for other reasons, like you want to mentor, you want to help the next generation, you're particularly interested in some sector. But if you can't outperform 25%, it would be for those reasons rather than financial reasons. Okay. I think that, by the way, COREangels is probably going to develop some sort of fund like this as well. As there are more COREangel groups around the world, there'll be an easy way to sort of invest in all of the startups that COREangel groups invest in. And so that's probably something to look forward to as COREangels continues to grow and mature. The second insight is, the more you invest, the better you do. So on the x-axis here, we have the number of investments, and on the y-axis is the median return. So this is a really amazing chart because it says that, all the way up to 100 plus startup investments, the return improves. And the good question to ask is, why is that? So one obvious reason is that you get more and more experience as you invest more and more. So this is very different than the public markets, right? In the public markets, experience almost doesn't matter, right? Like individual investors can't outperform the public markets, essentially. But the other reason, which I'll talk about more in detail, is that as your network grows, you get more and more access to more and more good startups. And so I'll return to this later because this is sort of a very important concept, right? In the public markets, you can invest in any stock at any time on any day. When it comes to startups, there's no single program, there's no single website that has all of the startups. So just having access to the successful startups is a source of significant edge, right? And so as you invest in more, you become better known, you network more, you know more people, and so you have more opportunities to invest in the better startups. So my general advice is to not start angel investing unless you're willing to invest in 20 startups over 5+ years. And it's for this reason, because you'll get access to more and more startups. And so that leads me to really what my best insight is and what most of my investing is based on today, which is that one way that the network grows is that you get to know more and more startup founders who have already been successful ones, right? So these are second-time founders. So they started a company before. They may or may not have sold it, but they started a company before, and now they're starting another company. And what is true of these second-time founders is that they give you options, shares, opportunity to invest at a lower valuation than they deserve. And that's because they care a lot about speed, right? And so This is something that I investigated in with my own startups. And I said, you're a second-time founder, you could probably get a bigger valuation. And the response was, I do not want to spend 3 to 6 months raising my first round. I want to get my first round done as quickly as possible because it's a waste of time for me to spend 3 to 6 months raising money. And I just want to call up a small number of investors, have them invest, and then run for 18 months. And so what you're getting here is the opportunity to invest at a lower valuation because the entrepreneurs want speed. Okay. And so here are some of the numbers below. So the first row in this table are entrepreneurs that have had no previous companies, right? So they're first-time founders. And if we look at the percent with exit, the second column to the right, about 3.96% of them get an exit. So as soon as you've had one company before, that number goes from 3.96% to 7.15%. So it doubles, right? And on the right side, the percent with a big exit, that almost triples. So there's just a huge edge in having a second-time founder versus a first-time founder. And since the valuation doesn't increase, you get the valuation at a little bit more of a premium, but not twice as much. There's a lot to be gained by doing this. And so what I do is I look for second-time founders. And so here's one simple thing that all of you can do, which is to find founders that you're impressed by and go out and build relationships with them, right? So John Radoff here on the left side is a person who's started like half a dozen startups, and I develop a relationship with him and I say, look, I would like to be the first check in your next round, right? And I did this, a couple of years ago, and then I keep circling back with him and building the relationship. Ian Crosby is the founder of Bench.co, which is a very successful accounting company. And I've been pinging him for a long time, right? You see here, since 2018, I've been speaking with him. And he just told me that in 2023, he will probably start another startup. So very successful bench company, right? VC backed, et cetera. He'll have a big exit. And now I'll be one of his first investors in 2023. And so this is something that all of you can do. It obviously takes time, but this is part of the commitment to start developing relationships with people who are successful right now. They've done an A round already. They've raised VC capital. They know something about managing dozens of people, building a successful product. Build a relationship with them now. And then when they start their next startup, you can be the first check-in. Okay, and now I'm going to talk about things that I don't have a lot of data about, but I have guesses. So here's a process. So COREangels has a more elaborate, sophisticated process for angels to follow. This is a very simple one. And it's on the left side, you get access to a startup, you select them. Once you invest, you can mentor and then do follow-on investing. And so for Silicon Valley style startups, access is very, very important, right? Access is something that you can actually invest yourself in and become better and better at getting access to the best startups in whatever ecosystem you're in. So in the United States, that's a huge edge, right? The hottest startups are oversubscribed and they actually turn away investors. So being one of the investors that they take a check from is extremely valuable. Another idea, which is something that I learned very early in my investing career, I was meeting with a startup that had gone through a very well-known accelerator. I said, I'm very interested in what you're doing, possibly interested in investing. And the startup founders told me that they weren't thinking of starting the company. And I was like completely flabbergasted. They had gone through an accelerator and they were not going to start the company. Why would they do that? But it actually turns out that many entrepreneurs that I've met, startup founders, are not actually seriously committed to starting the company. And if you can just eliminate those, that is a huge edge, okay? And so Paul Graham, who started Y Combinator, points out that it takes a startup a year or two to find out what their business is. And what I found is that during this year or two, early stage founders are very comfortable just shutting down the business and going back to work for another company. Okay. And one very important point here is that today engineer salaries have become extremely high. In the United States, an engineer with 5 years of experience makes $2,000 a day consulting. And so when a startup is willing to take a very small check, that is an indication that something strange might be going on, because the alternative to it would be that they could be just doing 5 days of consulting per month and running their startup, and they could pay all of their bills by doing that. And so when a startup says, we want to raise $100,000 or $250,000 in the United States, that probably is an indication that they're not for real and that they're sort of doing this as a hobby. And so the Access Fund, which I mentioned before, the Angel List Fund, has these amazing returns, right? 25 to 30% annual returns. And it could be the case that this is what's happening, right? Which is that they're successful. They invest in a massive number of startups, 200 plus startups a year, but they're eliminating these ones that are not really startups, where the entrepreneurs are not actually thinking of starting the startup. Okay, and then the final thing I'll say to all of you who are new angel investors, and this was something that was a complete and total surprise to me, was how much work is required to do the legal and accounting when you're an individual investor and you're directly investing in a startup. And I'll give a couple of examples of this. So one is, there are tax benefits when I lose all of my capital in a startup, right? So I invest 25,000, the startup goes bust, and so I make zero. So I've had a loss of 25,000. Now, in order for me to get those tax benefits, the startup needs to give me with some certain paperwork, certain legal paperwork. And what I discovered after I became an angel investor is that getting this paperwork is very, very difficult. Like, the startup founder is done. They don't want to do anything more. It was a tiny startup to begin with. They never got to round A. And so sometimes they don't give me those papers, and I don't get the tax benefits, right? This I'm showing you, this is from a recent acquisition for one of my startups that got acquired for 250 million. And the process, once the acquisition has taken place, to just get one's capital is far more complicated than I ever thought it was. I thought it was like you get acquired and then the investors get a check, right? That's not at all what happens. There's all these handoffs to all these different organizations. Like, this company is called SRS Acquium. I have no idea who they are. They were just like some legal/accounting organization that is now involved in the transaction. And they're going to be sending me reports about where the capital is. It's sometimes in escrow, some piece will be paid out to me, et cetera, et cetera. So I now know this, but I just want you to know, right, that this is far more complicated. And so this is a reason to join a group that will do all of this for you and give you like a single piece of paper and a single check, because this is actually an enormous headache and it's an enormous cost, at least for me. So with that, I want to end, and I'm happy to take any questions or comments that people have.
Thank you, Michael. Super interesting. We already have a couple of questions for you. The first one is from Andrea from COREangels Atlantic and COREangels Madrid. The question is, are unicorns of 2022 comparable to the ones in 2013 based on valuations being done?
Oh, no. So no, that's the thing, is that everything has gone way up, right? And so I'll give you a funny example. So there's a very famous VC in the United States called Brad Feld. And he sold his first company, which was a real company with revenue, for $1 million. Like $1 million total, not for him, but total. That was the cost of $1 million. And today, $1 million, like every single entrepreneur who goes to anywhere is worth $1 million. Like, they don't have a product, they don't have customers, they don't have anything, right? So valuations have gone way, 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 way up, right? And that's like one of the benefits that we've gotten as angel investors, right? Which is, companies that used to be worth 5 million are now worth 50 million. And companies that used to go bust are now acquired for 10 million. Like this company that I just had acquired for 250 million, it's 40 something employees and it's pre-revenue, right? So, in the 1990s, that company may not have survived, and now it's being acquired for 250 million. So great question.
Andrea has a second question for you, Michael. Do you think there can be a delay for early stage funding, considering the current impact at late stage, like a cascade backwards effect?
Yeah, so eventually, if we are in a significant down market, that's what will happen, right? Because of this thing that I shared, right? Which is basically stock market drops, people get laid off, and then real estate goes way down because people can't pay their rent and they can't pay their mortgages. And so then we have, a serious multi-quarter recession, and that will cause people to pull back on the fringes. So far, that hasn't happened yet. But if we're in a long enough one, then that will definitely happen, in terms of the broad market.
Thank you, Michael. Third question for you from Adrian from Transylvania Angels Network. Question is, why do you think a successful founder will raise another successful startup? Would you invest even if the new startup is not under the scope of your investment thesis?
Yeah, so the reason that a founder goes to raise another startup is because they're entrepreneurs, right? So, I once heard an entrepreneur as a person who can't work for someone else. So the two choices are vacation for the rest of your life or start another startup, right? And so the startup founders that I've invested in, are much younger than I am. They have many, many decades of work ahead of them if they want to. And so they start a company and then they start another company and then they start another company and then they start another company. That's what they do for a living, right? So it's not about the money. They have more than enough to retire. It's just that's what they're interested in, right? That's what they do. And then the question about the investment thesis. So I'm very relaxed when it comes to my investment thesis. So my investment thesis fundamentally is that I want to invest in extremely large and fast-growing companies, right? That's my investment thesis. So it's not a particular sector, although it happens to be typically software because I like low capital intensive businesses. And so it's typically the case that the second time founder basically wants to build a bigger company than they did the first time. And so it will actually always be consistent with my investment thesis. For those of you who have sort of an industry focus or a geography focus, that might be different. The very last question, how do you see the chance of European startups to find funding from US investors? Any advice? So I will say this is extremely difficult to do, right? It's extremely difficult to do. I have, friends and investors in Eastern Europe. And even with friends and investors in Eastern Europe, I say find people from Eastern Europe. So not even go to Western Europe because it's just far, far harder. It's just extremely difficult to do that. Like the investment I have in Argentina does not have any significant US investment, does not have any funds in the US. It's a huge bridge. And so typically you have to have a significant amount of success, like 100 million valuation, before organizations outside of the geography or the country will invest. The one tiny exception to this is that the extremely large VC funds have now started creating a presence in multiple geographies. And so you can go to the local presence in your geography of something that was originally from the United States and get an investment from it. But even that is just very, very, very small today. It's still very, very geographic. And like even in the United States, within the United States, it's still primarily the case, for example, that Silicon Valley investors primarily invest in Silicon Valley. In Boston, that's 100% true. In Boston, almost every major VC just invests locally, or Angel Group even invests locally. And so they're really focused on their geography and they don't invest outside. So that's just starting. As I say, someday, decades from now, it'll be like the stock market, where anyone anywhere can trade any stock in the entire world, but we're very, very, very far away from that today.
Michael, we have
Yeah,
another question from Richard.
Yeah. So ESG factors are a rapidly growing area in PE markets. Do you consider these when making early stage investments? If yes, how? So I'll say that I recently moved from San Francisco to Boston, and I called up a bunch of angel investors just to introduce myself in the Boston area. And I was amazed by how many people actually have ESG as their thesis as angel investors. Like a third of the people have ESG as a key part of their thesis: green economy, blue economy, things like that. I do not consider that in my investing. And in particular, I don't care about the exit path. So that's another thing that has changed, right? So I remember, in the 1990s, a business plan would say, here's how we're going to exit, here's how we're going to return investors' money, here's who might acquire us. And so I assume that's why you're talking about PE markets. That's no longer a thing. If a company is significant, it will get acquired, right? Every large company, every international company nowadays has a huge M&A group that does digital acquisitions. And I learned this in like 2011, in my early days, where I had companies that I had never heard of acquiring startups that I had invested in. And I would say, like, why does this company care about this? And the answer is that everyone cares about digital, right? So someone might be making coffee for 100 years. They have a digital group and they will acquire digital startups. And so it's no, the exit path is not all that important to me. I just care about the fact that they are going to build something significant and then someone will acquire them.